Hello, and welcome to our fourth quarter strategy review, which we recorded on Zoom earlier today. With me on a Zoom call was Len Skena, CEO and director of the firm, and Bob Toomey, director of research and director of the firm. Also joining us as our guest was Dean Almondson. Dean invests in bonds. Couldn't have think of a more applicable time to have someone invested in bonds talk to us with interest rates being as low as they are. And that certainly proved to be a positive. As you will see when we go through how our investments are handled in each one of the sectors. Right now, I'd like to turn it over to Bob to talk about U.S. equities.
Thanks, Dan. So as you may be aware, if you follow the financial news, and hopefully you have better things to do than that, but the stock market has actually been for quite a while now confounding a lot of the experts, so-called experts, and has been continuing to move steadily upward. And the reason for that really is primarily it's discounting a recovery from the COVID-induced recession of last year. The economy continues to gradually strengthen. We continue to see employment growth. In a general sense, we continue to see the unemployment rate dropping, and we see consumer spending strengthening. And as a result of all of these things, in addition to capital spending, we're seeing corporate earnings continue to rise. We are seeing in 2021, this year, probably one of the strongest years for corporate earnings that we've seen in quite a number of years. And we expect them to remain strong in 2022 as well. So that has been the primary catalyst for the stock market. In addition to that, interest rates have been remaining quite tame, if you will. We had a little pop earlier in the year, but if you look at the 10-year Treasury, it moved back to the 1.3% range. And in general, rates have pulled back and are creating sort of an interesting backdrop for both stocks and bonds. And so that has been good for driving up the price of stocks. But one concern that we have that we discussed at the meeting really was valuation. And stock market forward valuations on the stock market are pretty high when you look at the historic ranges. We're up around 21 or 22 times forward earnings, which is on the high end of the historic PE range. So the concern is that if interest rates go up unexpectedly or severely, that would put some pressure on stock valuations as well as bond valuations as well. So one of the key things that we did at this meeting was we actually slightly reduced our weighting in U.S. equities. Not a great amount, but we think that it was prudent given where we are in terms of valuation, and also the fact that we believe that U.S. equities have gone a fair amount of the way of discounting this significant improvement in corporate profits. So now I think what remains to be seen here, September and October do tend to be volatile months. I think we want to see what the Fed is going to have to say at their FOMC meeting next week. And we want to, we definitely want to see what October brings. But the point being is that I have to say that we have been right in continuing a strong overweight in U.S. equities. This pullback in our exposure is very small, but we think it's prudent given the concerns about valuations. So I'd like to turn it over to Len to talk a little bit about international equities.
Thank you, Bob. On the international front, we continue to favor the large developed economies. The EAFE index, which stands for the Europe, Australia, and Far East, has always made up the bulk of our international component, and it will continue to do so. And what we've done for this quarter is made it the exclusive component of our international investment. We have taken the position that we had in emerging markets out of the portfolio because we have some concerns about some regulatory issues in China and the fact that as China maybe suffers a little bit, the other emerging markets are going to be dinged by that. So going forward, we feel more comfortable being in the large developed economies. We feel that that's the best place for the international allocation to be at this time. And that's where we're weighting our allocation completely. With that, I'd like to turn it back over to Stan to talk about REITs.
Thanks, Len. REITs is an area that I have favored for a long period of time, and the firm has continued to favor the REITs. Interestingly, there were a lot of discussions about a lot of things that we reviewed this quarter, but REITs were not mentioned much. But in reviewing what REITs have been doing, they've actually been doing quite well. And consequently, we still feel very good about the REIT area. One thing that REITs always do, since they're a pass-through vehicle, is they pass through 90% of everything they earn, and they must to qualify as a REIT. This means that we get better returns than most any other area within our investment portfolio. Also, this time we continue to emphasize the rental real estate because REITs are made up of three primary instruments. One are large apartment buildings, which again, we chose to emphasize by having an additional investment in just that area in a REIT, and large apartment stores, shopping areas, and the one area that we question is the large office structure. However, they're still building a lot of offices out there, and we reminded ourselves that large tenants, the Microsofts and so on, continue to pay the rent even though they're not having anybody going into the office. So again, REITs remain a very strong part of our portfolio, and we continue to like them. With that, I'm going to turn it over to Len to talk about fixed income.
Thank you, Stan. On the fixed income side, we continue to emphasize the shorter edge of the yield curve. We want to go with the shorter durations, particularly in a world where we feel that interest rates are extremely low and likely to go up if they're going to go somewhere. Now, with that said, it's got to be always under the caveat, nobody really knows what interest rates are going to do. But we do see this as coming off of historic lows. We are in a position where we really want to protect our clients against any potentially sharp interest rate movements on the longer end of the curve, which would be more interest rate sensitive than the short end of the curve. We continue to hold many bond surrogates in place of, or I would say, augmenting the positions that we have in the Treasury area. In long-term bonds, we are continuing to use some preferred stock. In intermediate-term bonds, we are continuing to use a senior loans ETF that we like. And on the short end of the curve, we are continuing to gain some additional yield through a high yield bond fund as well. Those additional funds, along with the treasuries that we're in, and the fact that we're skewing things to the short end of the curve, will hopefully provide sufficient income with some interest rate protection in the event that things should happen to go up. With that, I would like to turn it back over to Bob to talk about other changes in our models.
Thanks, Len. And I just want to just reiterate a couple of things that both Stan and Len have mentioned before, that our meeting with Dean Amundsen was, I think, an excellent meeting. We discussed a lot of aspects of the fixed income market. Dean is a long time experienced and seasoned bond guy. And it was very interesting to hear his commentary. And I would have to say that I think that his belief is that the sort of the risk reward for bonds is not very favorable right now. And that really, as Len just mentioned, really supports our desire to be more skewing our duration towards the short end. I also just want to say that my comment earlier about reducing our equity exposure, U.S. equity exposure, does not in any way, I think, reflect any kind of concern about the long-term, growth of the stock market or the long-term potential for the stock market. I think it's just, we periodically from time to time have to think about managing risk, and we just felt that given the run we've had, reducing U.S. exposure was probably a prudent thing to do for right now. With respect to holdings, as Len mentioned, there were the only change we really had this quarter was we eliminated the position that Len mentioned in the XSOE, which is the emerging market ETF excluding companies that are owned by a sovereign nation or heavily controlled by a sovereign nation. We still continue to maintain positions in the VanEck Wide Moat ETF, which is Moat, which we like a lot. We think Moat gives us good exposure to both the value portion of the market, and also the stocks that are held in this ETF have to carry a buy rating from a Morningstar analyst. And the ETF has done extremely well over the years, and we think it's a great holding in US equities. We've maintained our position in the XME with the metals ETF, and also XOP, the oil and gas exploration ETF, both of which we think fit in well in the commodities area, and also is a hedge against inflation, which we expect, which we think could pick up here over the next year or so. With that, I will turn it back to Stan for closing comments.
Thanks, Bob. And in closing, I'd like to reiterate actually the fact that we always set triggers. These triggers are designed to just, if something happens that we didn't think would happen when we made our decisions, that would cause us to rethink that decision. Similar to what you've heard, we sort of stayed in a lot of the same positions this time because we felt that the market continued to look very similar to how it looked in the previous quarter. So what we did is to actually keep the same trigger, and that is looking at the Consumer Confidence Index. Now, the Consumer Confidence Index is pretty much what it says, and we feel that stocks and other investments will continue to do well because there's such a large amount of cash out there to be invested. So consequently, we continue to feel that the Consumer Confidence Index is a good thing to keep an eye on. And actually, that has been rising somewhat lately. So we think that's good news, but our trigger will remain as it was the last quarter, and we will continue to monitor closely that Consumer Confidence Index. With that, I'd like to thank everybody for tuning in again this quarter. I want to remind everybody that all of our quarterly reviews that we've done have been and are posted on our website. So if anybody wants to go out and look at what we thought in the past, even compare how we did, please feel free. It's all there for you. And we hope that we will see you again in the fourth quarter at the end of the year. Thanks again for tuning in.